Right now, it's time to welcome back my good friend and co-host, Jeff Small, president of Arbor Financial, a retirement income store located in Melbourne, Florida. Jeff's also the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. We also want to bring in Greg Daco, U.S. Chief Economist at Oxford Economics. He's responsible for producing the U.S. Economic Outlook using their proprietary global economic model. Greg's also a frequent guest on networks like CNBC and Bloomberg. Greg, thanks so much for being back here with us on The Income Generation.
My pleasure. It's always fun.
So we spoke last time in kind of in the middle of the summer, and you said, the things are looking pretty good. The biggest risk right now is if we have a double dip recession. Do you think we're out of the woods with that now?
No, I think we're actually right in the middle of the crux here when it comes to economic activity, because we've seen a significant slowdown in economic momentum. Mobility has fallen back, employment growth has slowed, demand is hesitant, and all that is due to a worsening health situation. So while there is hope in terms of vaccine diffusion for 2021, today's situation is actually quite concerning, and I'm a little bit concerned about the transition into 2021.
So a double dip, if you will, recession is probably going to come if it comes. If we're going to see it, we're going to see it first quarter of the year, are we not?
Yeah, I think one of the paradoxes in today's economy is that we're looking at average growth numbers in terms of GDP for the fourth quarter or even for the first quarter of 2021. And those tell you very little about the situation today. If you look at the situation in terms of high frequency data, you're looking at momentum that has essentially slowed for the better part of the last 6 weeks. And while that is in the fourth quarter average is really going to benefit from the strong end of summer momentum, where we are likely to see some increased weaknesses in the first quarter of 2021, and that will be reflective of a slow end of the year. I don't necessarily expect a double dip recession as my base case right now, but I do expect to see fairly low growth, below 2% on an annualized basis in terms of real GDP in the first quarter, which would be quite low given the fact that we're still below pre-COVID levels of activity.
If you think about a first quarter, we were only down 4% on GDP, but it fell off a cliff really in the last 2 weeks of the quarter. So that's another great example of where you're right. Sometimes the quarter doesn't accurately reflect the trends that are happening from month to month. Jeff?
We just went through a massive political change in our country, Greg, and obviously economic policies by, White House administrations influence what happens in the economy greatly. And we've got this huge Georgia runoff coming up here. And if there's a blue wave, it looks like Biden could get what he wants. And that tax increase of $4 trillion over the next 10 years means it's an average about $400 billion a year. Can our economy really sustain a $400 billion a year increase in taxes and still grow and benefit the middle class? Because that was the cornerstone of his election campaign, his run for the presidency.
So I think today's economy is certainly not strong enough to sustain a large tax increase. But I think we have to be a little bit careful on two fronts in terms of Biden's fiscal agenda. The first one is that in his fiscal agenda, I think he would delay any tax increases until the economy is in a stronger shape and ready to sustain any increase in taxes, especially on corporations and higher income individuals. The second element is that if you look at the likely path forward in terms of Congress, it seems more likely than not that we will have a Republican Senate. And so when it comes to passing parts of Biden's fiscal agenda, what's likely to happen is that we'll see very little actually of his fiscal agenda, and we'll see much more action in terms of executive actions on the trade front, on the immigration front, and perhaps even on the regulatory front, and much less on the fiscal front beyond fiscal relief packages that may be passed to help sustain the economy.
Well, on the divided government front, that's a great thing. On all those other fronts, though, it sounds like they can wreak a whole heck of a lot of havoc on the economy just by executive order.
Well, yes and no. I mean, the fact that the president has a lot of executive power is important to keep in mind. But in terms of what could happen under a Biden administration, I think we have to keep in mind that one of the key changes is going to be increased policy certainty. And that is non-negligible for businesses around the world and for investors around the world, because they have better foresight as to what is likely to happen and are better able to plan. So in terms of trade, we're likely to see increased openness to trade, perhaps not a free trade agenda, but increased predictability in terms of the trade agenda, perhaps a move towards more immigration.
Which is something we haven't seen really, over the last 4 years. We need to take a quick commercial break though. So Gregory, stay with us. We'll be right back. And you stay with us too. We'll be right back with Gregory Daco in a moment on the income generation. Now it's time to bring back my good friend and co-host Jeff Small, as well as a good friend of the income generation, Greg Daco, U.S. Chief Economist at Oxford Economics. So sorry there, Greg, I had to cut you off the kneecaps for one of those commercial breaks. But listen, I know you're saying that you think that having freer trade will be very helpful maybe over the next few years. But do you think having less than free trade really hurt us that badly over the last 3 or 4 years?
Yes, I think in general, yes. I think having the gradual increase in tariffs vis-a-vis China, having higher tariffs vis-a-vis Europe did in fact raise consumer prices and affected all of us in an indirect manner because the price of the goods that we consumed were higher. So yes, I do think that in the lead up to the COVID crisis, there was this restraint from increased tariffs. And if there were one area to focus on more specifically from a Biden administration standpoint, would be to lessen consumer goods tariffs on final consumer goods, which tend to affect us more directly. It's too late for that to happen before the holiday season this year, but it could happen perhaps later in 2021 before the 2021 holiday season.
Well, what's interesting about that, Greg, is that Biden has said that he's not going to get rid of the tariffs. He's not going to pull the tariffs off of the Trump tariffs on the China trade deals they did.
And yeah, so, I think we have to be very careful with an assumption that he's a pure free trader. He's not a pure free trader. So he is likely to maintain a large share of the existing tariffs. But I think increased predictability and perhaps a view towards limiting the effect of the tariffs on the most affected tranches of the population would be key and would be a good support to additional growth. So making sure that consumers aren't excessively affected, making sure that you're supporting domestic activity instead of restraining imports and increasing the cost on domestic importers. Those are very important elements at this stage of the recovery.
Mm-hmm. And getting back to this possibility of double dip recession, you said it's not your base case, but can we almost eliminate that from consideration if Congress gets their act together with a CARES Act Part 2?
Well, I think right now, what is important, as you allude to, is the fact that we need to ensure that the most vulnerable tranches of the population, and by that I mean lower income households, small businesses, and state and local governments, have the means to sustain a recovery into 2021 and into 2022. That's really key right now. We want to limit the scarring to the economy as much as possible and enter 2021 with as much dynamism as possible, because again, let's see the positive side here. We're going to have a vaccine that's going to be gradually diffused across the society, and that will support stronger activity. So we want to be in the best shape once we get the vaccine.
So inflation, Greg, people are worried a little bit about inflation, it seems, and I know you even said, you didn't say it, but basically the tariffs have pushed inflation upward a little bit here in this country. But it seems to me as though we went through decades and decades where the Federal Reserve could do just about everything. They can stand on their head and spit nickels, and they couldn't really create inflation in the traditional sense. What they were creating was asset inflation. So, moving forward, we don't get a double dip recession. Congress does start to work together, which would be a novel idea, of course, and get CARES Act Part 2. Things come right along. Is it going to be more the same? Do we really have a threat for traditional inflation, or is it going to be more of that same asset inflation by pushing people up the risk curve that we've seen now for the last decade or so?
Well, I think when we look at the inflation picture in 2021, we'll have to be very careful about what's driving inflation, because we will see inflation accelerate and accelerate beyond the Fed's 2% target. That's going to be a factor of, first, the base effects, because we're going to start from very low comparison points, looking at this last spring. And second, because economic activity is going to accelerate once people feel safer to travel, to go about utilizing services as they did pre-COVID. So we will see inflation higher, but that's likely to be transitory. I think what the Fed will have to do is ensure that it maintains a solid path and solid support in terms of economic activity beyond that initial early 2021 surge in inflation, and guarantee that the economy is on a strong path and in which inflation is actually in line with an underlying path of stronger growth.
Mm-hmm. So transitory meaning maybe for now, because the increase in production of goods and services hasn't really kept up with the short-term increase in demand. But as the production and the supply essentially catch up, then inflation after that transitory period should get back to maybe what we've seen over the last decade in terms of a pretty low rate. Is that what you're thinking?
That's our fear, that there are going to be pockets of higher inflation. And we've already seen some wild swings month to month in inflation because people are spending more of certain types of goods that are low in supply. Used cars is a great example where the price has really surged towards the fall of this year. We will see greater demand for services, and that will put upward pressure on the service sector side of the economy. Going into 2021, the back end of 2021 and 2022, the key question is whether we'll see strong enough growth to support a stronger inflation environment, even if the Fed maintains a very dovish bias. And that's going to be the key challenge for the Fed going into 2022 and 2023.
I couldn't believe it. I went into a car dealership, and the salesman who had purchased 2 cars from over the last 20 years actually took me to the showroom floor, and they had one new car of a certain model, just one, because production had been slowed down for so long. It was absolutely crazy. So, Greg, thanks so much for being back here with us. We really love having you. And you stay with us. We have much more coming up in just a moment on the income generation. Jeff and I will be right back.